Welcome, everybody. Happy Halloween. If you're not a believer in Halloween, just have some fun today anyway and eat a lot of candy. I'm Jim Franklin. You guys have met me before. I've got the whole team here with me, and we've got a lot of people in person. So I apologize ahead of time for talking to the in-person people. Hopefully you will all hear that. If anybody cannot hear me, how about coming up in chat and letting us know? But I think we should be good. It's going out right. I'm going to introduce you to a couple of people. We have some prototypes here in person. You guys, in-person people, can take a look at them over there on that table and stuff. They're clients that are here. I'm going to introduce you to Mercy Best and her company called Steam Kits. And I'm going to propose that if you are not caught up on your deliverables and you're having trouble with them, then let us know in chat. And I'm proposing that we, Akosha, come up with some deliverables workshops or something, you know, where we can get a group of people together and try to get this thing nailed out. But we can do that during office hours. Why do we do pro forma financial statements? Besides people like me that are the bean counters just wanting to do it to feel comfortable, the real reason is that we are looking to project your company's value on something that is finite. There are a couple of other things about financial projections that, to me, make them valuable in a business planning sense. One, it is sort of the canary in the mine shaft. Your pro forma statements tell you early on whether or not you've made a mistake about your pricing or whether or not you've made a mistake about market capture and that kind of thing. It is also a very orderly way to plan your business. If you understand your pro forma financials, all of the numbers came from someplace that's part of your business plan. So that's sort of what we're doing today. I will say this, that money isn't the only measure of value in your company, but social value is very hard to measure, particularly for investors. And money is just an easier way to quantify the value of a company. So that's kind of my intro to where we're going. Here are my source materials for today. Are the two templates that you've been using, hopefully already, your business plan outline and the Excel workbook that is the pro forma financial statements. Here's where you should be. You should have a very, very firm business plan outline. You should have completed your strategic roadmap, at least to know what you're counting on for the next 5 years. I think you should have identified your target markets and drafted a revenue model. So your target markets are who you're going to go after, and the revenue model sort of says how much of that market do you think you're going to capture and turn into income. And I would hope that you have, after last week, after Bill's session, a rough draft of a sales plan, at least in your mind. How are you going to sell what you make? I always have to say this because this is my field and I tend to get like real nerdy about it. Don't let finance be overwhelming. I'm going to try to make it as easy as I can for you to understand it at a practical level. So I have to apologize ahead of time. The goal here is to accurately display your company's performance in a practical sense. So my apology goes out to any CPAs that are out there. This is not necessarily the way that a CPA would look at it because it is not necessarily based on taxes or GAAP. It's simple, it's practical, it's user friendly, and I will say it's accurate, but it is forward looking. This is just a review of what we're trying to do here in the program and how this fits. We're looking to grow your company along with you. That's essentially what an incubator does. If you're not asking questions and participating, particularly to the in-person people here, then you're not getting the most out of this thing. The cohort is there's a wide variety of enterprises in the cohort. Some are just ideas, but some are all ready to go to investors. So Keisha and I just had a talk about her business, and she's ready to be in front of investors. So she's late stage enterprise. Don't get disheartened about that. You'll all get there from here, but we can watch her. It's a 12-week program, and where we are right now is at the end of the second month, if you will, or the end of the financial strategy. 7, 8, 9, 10, 11, and 12 are really about getting ready for capital infusion. So if you don't understand what we're doing today in this one, regardless of how much fun I try to make it for you, my bet is that you're going to be behind for the rest of them. So let's not leave this session today with anybody not understanding. Go ahead, Brett.
Question, Jim. I saw that you have the business plan outline. I know that we have some templates. So was that business plan outline its own special template that was available in?
Yeah, the business plan outline is a template.
Yeah,
it's a Word document.
I'm looking through and I may have missed that one. I mean, I have a business plan, but I just want to see the outline that you all have.
Yeah, it's in the, it has been uploaded into the rest of the templates.
The executive summary.
It may be called executive summary.
Yeah,
Okay, so,
you'll see a letter that you need to change, and then after that is the outline of the business.
okay, so I'll do that.
So don't get past today being confused. Here's how we're going to do it. Once again, I'll tell you that this is a venture capital investor looking at early stage business financial projections. Basically, I want to know what helps you value your company and to have your company succeed. I'm going to spend about an hour and 15 minutes doing that, about 30 minutes of Q&A that'll be open to everybody. And then at the closing 15 minutes, Akosha and Tiffany and Bill and I will continue to answer your questions, but we're going to talk to you about what we expect to happen over the next several weeks. I've said these rules of the road before. The bottom line there is to challenge me, because if I'm saying something that doesn't make sense to you, I've probably made a mistake about it. So stop me there. We got any questions yet?
No.
All right. Observation number one from me: pro forma statements are forward looking. That by definition means they're going to probably end up being inaccurate. The important thing is that the assumptions that you make and the underlying foundation of what is in your pro forma has to make sense to you first, investors second, and your employees third. So it's got to make sense. It's got to have a good underlying assumption. These are pictures that depict what a venture capitalist thinks when you provide a pro forma that doesn't make any sense.
It's a bad.
Actually, a Madagascar fruit bat.
I told you you had some interesting pictures.
Yeah, there you go. All right, here's an outline of what we're going to do. I'm going to throw a red line under the first four, because these are kind of breaking points. That first four is to set the stage for what we're talking about. The next four are the details that go into pro formas. And then the last, oh, how do I go back?
Scroll back.
Whew. I love technology. Okay. The last two are about how these statements interrelate. And most important for those of you that are out there in advanced business like Mercy and Dr. Jen and Keisha, these are the basics of how you put a monetary valuation on your company. And that's what all this leads up to. Okay, observation number two, and then we'll take a small break for questions. if you're going to be the master of your universe, you need to own the financials. Leaders who don't know money are like dogs that chase cars. The dogs always have a lot of fun till they catch the car, and they don't really understand what they're doing. They don't have purpose. So again, if you want to be the master of your business universe, you have to understand the financials and not be afraid of them. You need people that don't understand financials and complain about the financial realities that they're facing are kind of like whiners. You're going to end up on the outside looking in. You're going to end up dependent on your accountants and financial advisors to do things that you ought to be doing yourself. So if you're going to be a business leader, you got to own financials. So enough said there. Before I show you this picture, I have to give you the caveat that no children were harmed in the making of this slide. That actually is my grandson, and that actually is my airplane. However, my son photoshopped this bad boy to put a runway out there. But the purpose of this is you're going to be on the outside looking in and whining a lot if you don't understand your financials. I'm going to ask 3 questions and anybody can answer them. So the first one is, which of the financial statements shows the company worth? And your choices are balance sheet, income statement, cash flow statement. So I'm pick on the NSU student here, finance major. So of those 3 statements, which one shows the company worth?
You said which ones again?
Balance sheet, income statement, cash flow.
Isn't it cash flow?
Okay, that's a good guess, but that's not right. The worth of the company is measured on the balance sheet. So remember that the value, the worth of the company is on the balance sheet. Okay, which statement shows operational efficiency? That's kind of a part of worth, but it's how does the company run? And is it, go ahead, Bratton. No, it's income statement. Okay. Yeah, well, everybody gets it. Everybody gets this wrong. That's the purpose of these questions. Okay. So which statements do you have the most control over? Income statement. Income statement. And if you think about the income statement as a budget, you can control everything that's on your income statement. You can make decisions about that. Your balance sheet is something that is a result of other decisions you've made. You know, it's just a report card, if you will. Income statement is an ongoing thing. How did I do last month? Well, I had control over that because I could have generated more sales, or I could have not spent as much money, or I could have been smarter about who I was selling to. And the reason I ask that, and everybody, by the way, most people get this wrong, is that to understand financial statements, you have to understand what they do for you. So again, the balance sheet shows the worth of the company. The income statement is the thing over which you as a leader in the business have the most control over. And then those are kind of all working together. All right. The profit and loss or income statement is a budget document. The balance sheet shows what you own, what you owe, and what the difference in that is, or what the equity in the company is worth. Now, do you see why the balance sheet is what the company's worth? Okay. And the income statement tells you how you're doing. The statement of cash flows shows where do you get your cash? What do you spend it on? Here's the important part. How much are you going to need over time? There are 3 parts of it. Cash that results from operating the company, cash that results from investing, and cash that results from financing. And we'll talk about the difference in those. But all 3 of these statements are required to paint a financial picture of your company. What you'll find is that people gravitate towards the income statement because that's the one we understand the most. And then they use the balance sheet for a purpose when a bank asks for it. Nobody, almost nobody does projected cash flows. And that, believe it or not, is the largest reason that small business fails, is insufficient capital, insufficient cash. All right, questions?
The last one, you said control the balance sheet as well, right?
I'm sorry?
You said the, which statement do you control the most?
No, that's income statement. You can hardly control anything on your balance sheet. It just results from other stuff you've done. All right, here, again, Mercy's up. Oh, I see her. I thought you might be coming in today, but you're not. So Mercy Best Company is called Steam Kits. It's a really cool thing. If you were here, you could see one of her steam kits over on the table. So the rest of you all look at it over there. The concept of the company is that their mission is to make STEM less daunting and more accessible to young people based on bringing arts and other entertainment things into the world. And these kits are provided to parents and children and schools to have activities that involve the principles behind STEM. Did I say that right, Mercy? I hope. All right, this is Mercy's Pro-Forma financial summary, the beginning of her income statement. And this income statement, remember, is the one that you have the most control over. And this is the format of it. Revenue is at the top. And these are the three kinds of revenue that she's making. She actually has many more lines of revenue than this, but this is the first three we started with to project. This is what it costs her to make those products, about 50% of the sale price. And then her SG&A, or selling, general, and administrative expenses, are taken off of that. And that shows her EBITDA, or earnings before interest, taxes, depreciation, and amortization. Don't worry about that. It's operating income and the operating margin. So she's losing money in her first year, her first projected year. She's already been in business a while. But if you take this out to the right out here, you can see that she's going to make money at an ever increasing rate out through year 5. So one of the things about financial projections that make them very dangerous is that you can hide behind them. So your financial projections, if you come to me as an investor, your financial projections are going to show me how you intend to make money. Now, I'm not trying to say that that's not important, but your leadership skills tell me whether or not you're likely to succeed at making money. So a lot of you, I harp on trying to come to as many of these classes in person as you can. The reason is people like me do one-on-one meetings with people, and no offense, but Zoom doesn't cut it. I need to see how people react, what they look like, what they're interested in. Are they animated about what they're doing? And more importantly, do they have the leadership skills around the people around them to actually make something happen? Because early stage business is probably the hardest thing in the world to do. And over time, people don't succeed. And I think the biggest reason is their leadership skills. So I have a picture that shows, I guess to me would be the best leader in times of crisis in my lifetime. So if somebody had asked the Southern Christian Leadership Conference what their business plan was, they would have said, we need to show some equity in this country. We need to see some justice come about. And for that, we're going to get a lot of donations and that kind of thing. But if it hadn't been for Martin Luther King, that business probably would have failed. This is going to seem just a little bit repetitive because Bill has spent several classes talking about budgets, because he and I are big believers in the budget concept and how you plan your company. But let's start out with, what does pro forma mean? It's Latin for a matter of form, but in the financial world, what it means is it's standard statements that are projections of what we're going to do. It is our best guess at what is going to happen if we do what we say we're going to do. So why do you do them? It sets expectations both for you and your company, but also of investors. So if you get in front of an investor without a pro forma statement, you're very unlikely to get money because they have no way to measure where your roadmap is taking you monetarily. It keeps surprises to a minimum. If you do a good pro forma, you've sort of identified all the risk areas and you put them down in monetary form so that it's not going to surprise you when something happens. You've already thought about it. It allows you to set objectives with controls. So you can give sales targets to your sales force that are actual numbers and they know where they came from. You can set cost limits on your people as part of the budget and they know why that cost is where it is so you can make money. It also helps you to do personnel planning. So Keisha, I'll pick on you. We just went over her pro forma and it's a really good one, but it's very front end loaded on people because she's in the software development business. She doesn't get anywhere without talent. Okay. So that's a nature of what she's doing. And what I said to her was, let's make sure that we're hiring those people at the right time so that we don't need more money up front than we actually are going to make money with. Go ahead, Brett.
You just raised, and this is local to me as well. When is the right time? Like, what is the measure? Is it more of a level of gaining a certain amount of revenue by a certain time, or like what is the measure that lets you know it's the right time?
No, I don't think you can use revenue as a startup or early stage as a measure because you're going to have to hire people to make revenue. So what I want to do is use the pro forma and my Manning document or my personnel plan, whatever you want to call it, to say, if I have these three capabilities, I don't look at them as, I should look at them as people. That sounds terrible, but these three capabilities are what I need in order when I start. In the software business, I got to have coders or I don't get money because I don't have a product. So the first thing is, do I bring people on that are going to get my product to market? Then I start looking at, as revenue comes on board, how do I get people on board that are going to help me grow? And a real simple way to do it is to look at yourself as the chief everything officer of your startup and say, what is the key skill set that I don't have and I need next? And then after that, what's the next skill set that I need that I don't have that I'm going to need? And then you're going to start generating revenue. And at that point, you can say, what is going to generate revenue fastest? You'll find at some point, usually at about the 1 year point, you're hiring more marketing and sales people because you've already got the product, you've already got it tested, you're already done, and the tech team is together. But the people that are producing revenue are not there. And I will tell you that in my experience in small business, that is the critical leadership requirement time. Because you got to make the tech people who have been the be all and end all of the company get along with the marketers, get along with the salespeople and realize their value. Answer your question.
That does actually.
I think the other thing that pro forma statements are good for is they are a measure of the management team's performance. So let me give you a little bit of a long-winded example. If I invest in your company, at the closing, I'm going to bring everybody together in the room. And the thing that's going to be on the table besides the ownership control document is going to be the pro forma financial statements. And everyone in that room is going to sign every page of the pro forma financials. You are now emotionally and legally bought into the plan, the financial plan. So when I go to Akosha and I say, you're the CEO of this company, we agreed to this pro forma, you did not make your sales numbers in the first quarter last year. Is there something I can do to help? Is there something, do we need more money? Is there something going on here? Tell me what's going on. That's your report card. So it's a measure of your performance, and any investor that tells you they're going to pick another measure of performance, you should be worried about it because it's hard to measure. It's their opinion. Go ahead.
Based off of that thought process, let's just say a positive scenario where you are actually well overperforming and you're doing really well across the board at certain numbers, and you realize that you've actually lowball, some of your numbers and so forth. So at that particular point, would you step in if you were offensive investors? Hold on, your pro forma is way, inaccurate now. You know that you're doing a lot better. So, like, is that a point in time where you let's not say negotiate, but you reset and redo over your pro forma for the next few years to project better numbers?
So the question is, what if you beat performance, which is the unusual part? Usually first couple of years, people are behind performance, but if you outperform, do you renegotiate the deal terms? In simple. So in early stage investing, when I put money in a company, if they believe that the pro formas are understated and the value of their company has been lessened because of it, then I expect them to tell me that. And if they do, then we negotiate terms of a deal where if you reach certain numbers, then we look at you being able to claw back or buy back some of the equity in the company, because frankly, I'm still going to make money. And that's the fair way to do it. Don't let me make you think that that's the way it's going to happen, because money people are money people and are driven by greed. And so if they're making a lot more money, they are not going to want to give it back to you. Okay. So at the closing of the initial deal, if you believe that you're going to outperform, make sure you bring that to the table. Just say it. You guys have gotten me at a bargain basement price. How do I get some of that back if I outperform?
So can I add or
Yeah.
ask a question? Doesn't it also have to be in your terms? Your deal terms?
Yes.
If you don't have it in there, then once it's already cemented, you're just stuck, right?
Well, you can, hopefully you get the kind of investors that are working with you and they're on the board. And it would be, I won't say it never happens, but if it's not in the deal sheet, it's unlikely for you to have a basis. So you're going to have to rely on your relationship with the investors. If they're fair-minded people, if they're good, all that kind of stuff. The other thing I will tell you is that if you have outperformed, you do not always have to distribute all of that extra profit to the investors. You can put it back into the company. You can, do your own stock buyback program. You can do, there's some other ways to do it. If you have, so I hope you all are outperforming your pro formas. More importantly, I hope you're all doing conservative enough pro formas for outperforming them as possible. The other side is really bad, is when you have inflated it, you don't make numbers. Now you're going to be talking about losing the company problem. Okay. Budget items. Sales targets are who, how many, and at what price. And those targets are in your pro forma. They're also passed on to your sales and marketing force because they are targets. Cost limits are fixed, variable, and I add payroll as a third thing because it is an item of interest in early stage companies. Payroll has bankrupted more companies than anything else. And I liken it all the time. My wife gets mad about this, but I say, when you hire somebody, you've married them. As opposed to hiring a consultant, you haven't married them, you're just checking them out. So payroll I add as a third cost limit. And all of my people understand that they can't hire their way out of a problem. They've got to be innovators. And then I do a break-even analysis. And I've got a slide, the next two slides from now, I'm going to talk about break-even analysis. But let me just ask an overhead question since we're not getting questions. Why do you need to know what break-even is? Yeah, that's the definition of break-even, but why? Why is that valuable to you?
Because you want your company to profit, you want to make money.
Yeah, you want to know when you're going to start making money, and you want to know what are the elements that went into, my burn rate. What do I have to make to keep the lights on in this place? So yeah, it's very break-even analysis is important for you to know a point in time when you're going to be on your own. You're going to be absolutely a business viable venture. Okay, a few more items on the nature of budgets. My belief is that most entrepreneurs don't do capital budgets because they don't think they need capital. And by the time they realize they need some outside capital, it's really hard to get because they haven't planned for it. So if you walk into, I'm gonna quit picking on me, I'm gonna start picking on Bill. So Bill is a high net worth individual. You go into him and you say, I need $300,000. I need it in 30 days or the company fails. It's a little late. He's unlikely to make the investment, but if he does make the investment, what does he know about you? You're desperate. He's gonna get you at a really cheap price. So I say that your capital budget manages what assets you need. It sets requirements, and requirements are broad range. What kind of things do I need? What kind of people do I need? Research and development, not applicable to every kind of business, but in one form or another, R&D is kind of important. So Crystal's got the world's greatest fishing glove. She did whether she called it R&D or not, she did a lot of R&D to find out more than the configuration of that glove. She had to find out the materials, the glue that stuck it together, how it could be manufactured, if it could be manufactured cheaply. So R&D takes in a lot of things. There are some intellectual property considerations, and while I am not a believer in patents in early stage companies, certain industries demand it. So Keisha has a great cybersecurity, almost enterprise software solution that's going to be very valuable to the community. She's also got patents that defend it, so other people can't take advantage of her intellectual property without her making a little money on it. So that's important in that industry. Before you go out and spend a lot of money on patents, in your intellectual property considerations, I think there's one more important question than any other, and that is, if I get this patent, can I defend it? Can I afford to defend it? And if somebody infringes on it, are they going to be so big that I can't go after them? All right. But
You
that's,
would just build that into your projections when you, Jim?
Yes, I would.
So I got you.
and then cash flow management is last on this budget line because you need all the other budget things to figure out how much cash you need and how you're going to spend it and that kind of thing. But more importantly, it's going to give you an idea of whether or not you're going to need to borrow money or you're going to sell part of your company to get it. And then the other thing is you need to be able to plan for a cash reserve. So I'll just give you my family business rule. We have 17 companies, and more or less qualified siblings of mine have created and run those companies, but we've kept some basic ground rules. And one ground rule is that you don't do anything else until you have built a cash reserve in the company that's equal to 6 months of your burn rate. So that ought to be a goal that you shoot for. Now, why do I pick 6 months? Well, my businesses are all in the entertainment, finance, real estate, and resort development world. We picked 6 months because we didn't want to have to go out borrowing money. We could have our own reserve to cover us for 6 months before we had to go to a bank and ask for money or go out for investors. So you have to pick your own time frame, but your cash reserve is based on a number of months of your burn rate. We're going to go over that here in a second. All right, I promised break even, but budget discipline is something you've got to have as a human being in the modern world, but as a business leader, you need to have it. How do we do a break-even analysis? There are two ways that I do it. The simple method is the first way. Come on. But the weakness in this simple method, the way I do it, is that it does not include cost of goods sold as a variable. So what it takes is your net revenue and starts there. So you define your burn rate. What does it take to keep the doors open, the lights on, and your people pay every month? And then you define the period of performance. What is your burn rate over time? Weekly, monthly, annually? Break even is the amount of funds you need to satisfy those conditions. So my break-even revenue is the amount of my burn rate over the time period that I pick. Okay. So my break-even could be 5,000 per month. Excuse me, if my burn rate is 5,000 a month, then my break-even revenue is 1,500 per week, 5,000 per month, 60,000 per year. Now, this is simple. This is simple. If you all send me your pro formas, I'm going to do this. I'm going to say, okay, she says she's going to require this kind of money every month, blah, blah, blah. I'm going to say, what's her break-even point? And if that doesn't equate to her income statement that she's given me, I'm going to say, okay, I'm missing something here.
So, 1,500 is like for, if you do this 3,000 every 2 weeks, so that's 6,000. Wouldn't it be 6,000 per month
Yeah,
and 72 per year?
well, yeah, kind
You
of.
just got the math wrong.
I got the math wrong.
Oh, okay.
Yeah, it should be 12,800.
Okay.
Yeah,
Okay.
good catch. I
You just
told
got
you.
hired as CFO.
Yeah, there
Well, I
you
got a
go.
math degree in engineering, so there you go.
All right, here is a more complicated, I call it the bean counter method, but it includes everything that you are going to have in the form of revenue to break even. So what's the cost of making it? What's it cost to sell it? So that's marketing and sales. What's it cost to deliver it? And then what's my cost of doing business or overhead? What is everything else divided up to get there? So I can use this method to figure out what the price per unit has to be for me to break even. So my break even price is the sum of all these costs per unit. So the total cost divided by the unit cost sold give you a break even price. And then break even revenue is the sum of all these costs by the time period. All right. So here's the simple thing about break even. It's going to give you a number that you need to make so that you are not requiring money going out the door, either through debt or some other form. All right. Anything else I've messed up?
Yeah, I'm just wondering what's your thinking behind the simple method as opposed to just adding cost of goods into that.
Because if you have that simple method and you know what your burn rate is, week to week as a business owner, I can look and say, how close am I to the bubble here? How soon am I going to be able to make, well, here's the big reason. Am I going to be able to make payroll? That's when I came up with the simple
No, I
method.
get, the payroll would be in there. I got you.
And I figured out everything else because the first business that my little brother and I started was in theater business. We built theaters and we were buying a huge amount of materials, which we borrowed money to do. Now I cared about,
Yeah, you were
what do I have to
financing
pay my
company, I
people? What do I have to pay my, to make my note payment? What do I have to do to keep the lights on and pay the rent and all that? And Bobby and I would sit there and I'd say, how we doing? Because he was on the road selling. And I would say, hey, what's our projection for the next 3 months? And he would tell me, and I'd say, we're going to be underwater by 300,000.
So, I mean, I know that you said the doors open, so facilities, lights on, blah, blah, blah. But you don't want to also add in, any like minimum credit card or loan payment?
Yes.
Okay.
Yeah, absolutely. The question was, as part of that simple method up there, what's it take to keep the lights on? Well, part of that is if you owe money to keep the lights on, then you've got to put that in there. So if you have credit card debt and that kind of thing that are going to shut you down, or you're not going to get away with not doing it, then you've got to include that. Good questions. Some thoughts on financial strategy. If you're going to make a strategic plan, you have to know what you can control, absolutely, what you can influence, because everything else that you can't control or influence, you need to forecast. As best you can, you need to be able to say, you know, I don't have any control over this, but this may happen. What's an example? Taxes. Great example. You can't control them to a degree. You might be able to influence them a little bit, but most part, taxes are taxes. So you have to forecast that.
And in returns.
Return.
Like if,
Oh, customer returns and refunds? Yeah, you can influence that, though, I would say. You can forecast it based on history.
But if you're just starting off and you're just launching, the first 6 months, you really don't have any idea of how many complaints or customer returns.
No, you'd have to use industry numbers to try to
I think,
forecast.
I think Jim's right. You'd find an industry standard and apply that and then see what your experience is.
And shipping costs.
Shipping costs are completely out of your control, especially now.
Yes, because nobody knew 3 months ago it was going to increase that.
Yeah, one of the companies my family runs, Updike Logistics and Transportation. We are loving this pricing model that's out there right now. Okay, start with your objectives at the strategic level. And by that, I mean, go big to small. So in your company, I know that many of you are not thinking about this, but you should think about exit positioning your company. Are you going to sell it? You're going to hand it to your kids? You're going to merge with another company? You're going to go public? I mean, all those things are kind of pie in the sky right now, but you ought to know that they are opportunities and you're going to position your company towards one of them. If that is your biggest target, then you can see how the rest of these move down, and it's kind of easier to envision it. So you're going to build value. You're going to use capital sources to get you through the part that's going to let you get to that point. And then you're going to figure out what merger or acquisition possibility might be out there and draw a line under that. Because that sort of is the part that you have to do big picture thinking about. The rest of these three down there are very finite. So you need in regard, I would say this, even in the service industry, you need a technology roadmap. You need to say, what is my product technology going to look like? And is that going to cost me some R&D to get there from here? And then I need to say, what is my market entry? And how do I get to dominance in my part of the market? And then how am I going to manage my debt? So these are the components of a beginning financial strategy, just the components. Do you have to write answers to all these? No, you need to think about all of them. You need to put it on your horizon. Debt management, I would say, you need to write down.
I have a question on the market entry and dominance.
Mhm.
What do you recommend as good sources to be indicators? Are you looking primarily at your competition, or are you looking at some other source to help you define that vision?
Your market entry is if you have competitors, that's your first and best indicator of how they entered the market and how they have begun to try to dominate it. So it's going to give you an entry point, maybe not an entry target. The difference between point and target is there's a piece of the market I'm going to go after. The actual individual I'm going to go after is this. Okay. So market entry is where and when. The other thing I would say to you is there are industry market studies out there. And for those of you that live around here, the Selden Library Business Research Center has huge resources on market definitions. And it talks about early stage businesses that can get to a market. That answer? Okay.
So in that market definition, I mean, I don't live around here, but in a normal library, maybe like a George Mason close to me, where would I
The
find?
George Mason Business Library is one of the best.
Okay,
Yeah, go to the business school library
okay.
and try not to get too upset by all the Republicans running around.
And
Here's my definition or caveats or whatever you want to say about financial strategy. Let me start out by this statement. Financial strategies are like war plans or combat strategies. They don't survive the first hit with reality. So that first bullet up there is they need to be flexible, and you need to be flexible. A strategy is nothing more than kind of an outline of your thinking. Don't make it a roadmap that has to be followed. Be flexible. You've got to withstand the changes in the economic, political, and operational worlds that you're going to deal with. Here's what I've strived always in my family businesses to make sure that my mother could understand my business plan. Now, she's passed a lot of years ago, but when we were forming a new business, she was the first person I had to make understand our strategy. If she couldn't understand it, it was either too complicated or it was really stupid, which happened. So I think you need to it needs to make sense to your team first and investors second. If it makes sense to your team and investors can't understand it, usually you're talking to the wrong investor. And Keisha, that's really going to be your problem. You've got to talk to the right. They have to understand tech. Any questions? Okay. This isn't a funny picture. I'll say that ahead of time, but it's meaningful. My number 4 observation is that the only purpose of financial planning is to make it easier for you to run your business. So once you have a financial plan in place, it ought to be easier for you to run your business. It frees you up to focus on something non-financial, like selling, like building, like doing, like dealing with people, okay? The other thing that a financial plan frees you up is that it can be handed to all of these analysts, lawyers, accountants, so that they don't ruin a good company. If you don't have a good financial plan, an accountant can run you right into the ground with detail. Okay? All right. This picture is about the liberation of a plan, but it's basically about everybody doing their own part and knowing their part and understanding what their part is in the bigger picture scheme of things. So this is a picture of Mongolian eagle hunters. And the cool part of this story is that they survive in the Mongolian desert by these hunting eagles. They find the food. The eagles bring back the protein. And so it's a very important part of that clan, that group, that village, whatever, that the eagle hunters are the most important people in the village. And this is cool because that is the first young woman eagle hunter in the history of the Mongolian tribes. All right. I'm going to go over some warnings that you have to give to investors and that you need to have in your mind about pro forma statements. But I'm going to start out by saying, get a good lawyer. Okay. By the time you write a financial plan, particularly pro forma statements, you ought to have a friendly, good relationship with an attorney that's not going to charge you by the hour to look at your pro forma statement. They're going to look at the pro forma package and tell you legally whether you've stepped out on a limb here. And if you have, now they'll charge you to fix it, to get you in the right place. So the first warnings to potential investors, and it's the first sheet of all my pro formas, you have to tell investors these things if you're an early stage company. accredited investors only. We're not going to get into the legal details of what an accredited investor is, but let's just put it this way. They are too rich for this investment to matter to them. You are not going to bankrupt them by them making an investment. So they are essentially untouchable unhurtable by your plan. That's an accredited investor. But you have to also tell them they may lose all their money. It's forward-looking statements and they may or may not happen. It is not based on registered securities. The worst thing in the world is you walk into a room full of investors and they start treating you like you're on the New York Stock Exchange. They don't get it. We're not regulated. So we're going to do it the way we think we should. If you get your own, they need to get their own lawyer and accountant. They can't use yours. And you and your advisors are not registered broker dealers, even if they are. In this transaction, they are not going to use their broker dealer license to sell securities. Good example. I am an advisor to all of you at one level or another. I'm a registered broker dealer because I have to be for my venture fund. I am not using that license to represent you to investors. They'll all understand that. Does that make sense to everybody? I will tell you, early stage companies don't say these caveats to investors because if you look at them, you look at all those and you say, why in the world would anybody invest? I just gave them every reason in the world not to. Okay. Well, the reason is that legally you have to protect them from themselves. You don't want to take somebody's kid's college fund. All right. Questions on the caveats?
Yes,
Crystal.
for the accredited investors only. So it's like, not like we can look at their bank account. It's like a card they show, or we just state it and then they, based on their actions, if they still engage to want to invest, that's how we know. Or
No, that is an incredibly good question. Let me tell you how it works. But the question from Crystal was, how do you know they're accredited investors?
right,
Okay. Or how do you prove it?
right.
Okay. When you go out and get investment, you're going to have a closing event. It means you're going to close the deal with legal documents. And part of the legal documents, they're, I don't know, Bill, how many years are, but they're 4 or 5 pages of certification questionnaire that the accredited investor says, I am because this is my annual income. This is my family's net worth. This is it. This does not represent more than 10% of my total liquid net worth. And at the bottom, sign, date, notarized. This is the document, believe it or not, that's getting Donald Trump in the most trouble. Because he attested to a financial position that they're arguing he was not true. So everybody that's an investor is used to filling those out, and we're all very careful about certifying.
And then also, when you do your term sheet and your safe note or your convertible note, it says that you certify that you're an accredited investor. It doesn't ask for details.
No, but most of us that will advise you will say it's better to have a certification package also. Because they can certify their accredited investor. In the informed consent world, are they informed enough to make that decision? You're making an assumption they know what that is. So they could always come back and say, well, they didn't explain it to me. I'm accredited, I'm smart.
Even though they're 2 lawyers.
I'd get the certification. Okay. Here's my other set of warnings about pro forma statements. Because they are projections, all pro forma financials are based on assumptions. It's very important that you know what your assumptions are, and I say you write them down. So you need to know that one of your assumptions is that the economy and the regulatory environment is suitable for your business and these finances. The pricing will lead to market acceptance. That's an assumption. The salaries and the loading on the salaries are assumed, not proven. We haven't hired anybody yet. So it is part of our assumptions. Aging of your accounts receivable and accounts payable, so the finance guy knows what that is, but aging is basically something you're going to assume. So I'll give you an example. The reason that people care about it is how long does it take you to get paid? That's accounts receivable. How long do you take to pay other people? That's accounts payable. What we have to list in our assumptions is what we're assuming for those numbers. My goal for my family businesses is that we pay everybody within 30 days and we demand payment within 30 days. Now, we don't always get it. I will say we always pay, but we don't always get, our payment within 30 days. What an investor cares about is if there's a mismatch. This is where shenanigans can come into pro-formas. If I say, for instance, I'm going to take 60 days to pay, but I'm going to demand 30 days to get paid. Can you see I'm floating 30 days worth of revenue there? Most investors like me will say, okay, normalize that equal amount. All right. Valuations are in private, not public markets. So one of the things that a greedy vulture capitalist might do is to say, Keisha, I keep picking on you because you're close to me, but she's in the software technology, even cybersecurity industry. So they would look at her and say, well, wait a minute, you're valued at this, but I've looked at these 3 public companies and your numbers are wrong. In which case your assumption comes back and say, we're valuing in private companies, not public companies. Are there any others that you can think of that would be assumptions? There's no right answer, but nobody assumed about COVID. 3 years ago, I put out some pro formas that are pretty sick looking right now. We hope that we can, overcome it. Inflation, economic. So I go back to economic and regulatory assumptions are important. Being a little specific about them is important as well. There are, you need, in the last note I'd say about the assumptions is for your industry and your plan. The assumptions is where you kind of start defining risk. You sort of say, we've assumed that this thing is not going to occur. If you're in the cannabis business, one of the risks and assumptions that you made in your pro formas was, indeed, the state of Virginia would legalize the sale for private use of cannabis. We did not see a new governor coming in. So your assumption would not have proved out exactly the way you did it, but you would have written it down. My assumption was it's going to be legal here. Okay. All right. So I've got all the questions cleared up here. Anything online?
No.
How do you project your revenue? The top line of the income statement. This is a key deliverable in the cohort too. So hang with me on this one, it's important. I'm going to pick on Mercy's company again. I'm going to give you an actual revenue projection that we did in her pro forma that led to that income statement I showed you earlier. Due diligence is what investors do to validate your market and your revenue projections. If your revenue projections are based on finite formulas with a solid base, then validating them is easy during due diligence. And here's what happens in due diligence. If your revenue is deemed to be inflated, the value of your company is commensurately reduced because your assumptions were too high, or projections were too high, excuse me. I like common sense over math models. Say that again. What about it?
If you say it's deemed to be lower, but what if it's deemed to be higher?
Then they're going to be real quiet.
They're
They're
not-
going to call that upside my favor.
oh,
Okay. That never happens
okay.
because they hire a due diligence firm. whose total job it is for about 25 or 30 grand to make sure your numbers are inflated. Okay. All right. My common sense is going to be illustrated in the next 6 steps, but it is common sense with a little bit of math, not math eliminating common sense. So I want it, by that, I want it to make sense to you all. So tell me if it does not, because we can't get to the next slide without this. So A times B equals C, where A are the numbers of things that we're going to sell. B is the dollars that we're going to sell them for. And C is the resulting revenue. So A times B equals C. Step 1, define the market. Step 2, define the targets within the market. Step 3, define the captures. How much of that market am I going to sell? How much am I going to get? That's the number. Not the dollars, that's the number. What step 4 is define pricing. Say again.
What's B again? The number of,
B is the dollars. That's where we're getting to now.
okay.
So define your pricing. And you can define that a number of ways. There are no, that's where math gets complicated, but make it simple. How many am I going to sell? What am I going to charge for it? And then the last one is do the math, and you will project revenue. I have a 6th step that is very important. Make sure everyone on your team knows where these numbers came from and where you've set the bar. And there's a concept in small business management, I guess large business too. It's called integrated product team, or IPTs. And that's every stakeholder in a company gets together to talk about building a product or improving a product or doing that thing. I use the same concept to do revenue projections. I throw my slide up on my IPT and say, this is what we think we're going to be able to charge for this product. Salespeople are going to say, oh, way too high. That's going to be hard for me to sell that. Marketing people are going to say, exactly right, we came up with that number. Does it make sense? So you're kind of team building. But your salespeople and your marketing people now understand how you got to their sales quota. And if it starts, any piece of it starts not paying out, not panning out, or not happening, they're going to come back to you and say, you know what? We went after the wrong target. They're not buying. All right. Mercy's company's example is next. All right. This is the simplest of simple revenue projection models.
I have a question,
Go ahead.
for just in general, right? And I will use mine as an example. So, I'm a week away from my entity being a year old. However, I didn't launch it until April of this year.
Right.
So when you're doing these particular projections, is it safe to do things as like a year 0, meaning that the stuff that it took to you to get into 2?
No, I don't do it that way because you're confusing a pro forma projection with an actual financial statement report. So here's where my year 1 starts. $1 is invested in the company. That's when my year 1 starts. So if anybody ever asks me, well, where'd you come up with that 15,000? You've only sold 650, in the first month. I go, yeah, you put in $1.5 million and you're going to see that 15,000 number in the first year. Give me a year to produce it. So that's my logic. That's my assumption. So we came up with the different kind of kits that Mercy has, and e-cards, and the football steam kit is the one that I've got in the house here. And how many, the yellow highlighted lines are how many of them per year we projected she would sell. The second lines down there under the yellow are the prices. You multiply the price times the amount, you get line item revenues, And the total down at the bottom ends up being your total annual revenue of all lines of revenue to produce. We're cool? So how many will you sell? What is they going to pay for it over a period of time gives you your revenue projection. All right, let's see where we are here. Yep, we're about 5 minutes behind. So I'm going to go through cost modeling of all of the math models and all of the things that we do. This is the one that is the least finite. Figuring out your costs ahead of time there's a lot of art in it. So I'm going to give you some outlines to help you. Fixed costs are the easiest costs to figure out. You know, what do you pay your people? What are your property costs? Because you know that, utilities, all that kind of stuff, you got pretty good. And debt and taxes, those are fixed costs. And I apologize to CPAs already. That is not the definition a CPA would use for fixed costs. This is pro forma building. Variable costs. Those are the things that change over time. So what you need to know is what your variable costs are driven by. How do you project them? And then the last thing, it's possible to forecast variable costs in relation to other things. COGS is a good example. It's kind of a variable cost, but it is a percentage of the price of your product or the percentage of the revenue. It's what you're going to spend on manufacturing it and shipping it and getting it to the customer. Here's some comparisons that I define. These are my definitions. When we go to the income statement, you're going to see gross profit, which creates a gross margin. My rule of thumb is I'm not going to invest in a company with a gross margin worse than 50% on their pro forma. I'm not saying they won't do worse than that. But on their pro forma, if they're already projecting to spend more than half of a sales price on a product, I'm saying your price is wrong. Or maybe you ought to think about going into another business. And here's why. The EBITDA percentage or the operating profit, the operating income number is 20%. That gives me a way to think about this is that it's my SG&A or my selling general and administrative expenses are going to be about 30% of revenue. That's just the way it works out. That allows me to have a net margin of around 10%. Now, I call these rules of thumb. So when you create your pro formas, I want you to very seriously take a harder look at it if you're not beating these numbers. Detail makes the best model. So the longer you're doing your pro formas and the more history you've got behind it, better model it's going to be. So Keisha can probably break all these rules because she's got 10 years of operating a company and she kind of knows what the numbers are and she's going to be way smarter than rules of thumb. But her detail is better. How do you figure out depreciation, amortization, interest, and taxes? There are whole courses taught in that. What I will tell you is it's not important in your pro forma statements to investors. We know what taxes are. We know what depreciation is. We know what amortization is. We certainly know what interest is, because if you borrow money from us, we're going to charge you for it. So I would say, don't worry too much about that right now, but get with your consultants and your accountants and you can figure it out. These questions are repeats. I've asked them before, but they bear repeating because they are the essence of your business. What do we sell? Who's going to buy it? What do they pay for it? Can we make a living at it at that price? Can we make our employees, customers, investors happy? Those are the basic entrepreneurial questions I have always asked my siblings. My mother has always asked me, and we have managed to succeed over the years by asking those questions early. early, before we form the business. We know the answers to these questions. But at the bottom line, you've got to trust your gut. If you feel like it's right, it probably is. Probably is. Don't get dissuaded by people like me. Okay. I have two pictures. But there is a thing in my world, because I'm a geezer, called the RCA dog look. It's a confused look that the RCA company used to have a dog called Nipper. And they had a gramophone, big old thing, and Nipper was looking in the gramophone and his master's voice came over it and he tilted his head like, you gotta be kidding me, what is that? So we call the RCA dog look when you have not connected with an investor or people. They give you a strange look. Sorry. The other one is that the RCA dog look kind of is what you need to look at yourself with these pictures. So I got Nipper on here, just for you, the old people that really did exist. Okay. But here's my favorite picture of the confused dog. But my real bottom line on this is most dogs don't understand finance. There's a reason for that. It's not important to the dog. All right, questions on the income statement, because we're going to go through the last two statements more quickly. Not that they're less important, but they are generated from the income statement. And the income statement is the driver of your business. Balance sheet, remember what I said? What you have or own, what you owe, and what's the difference between those two is what the equity in your company is. So the balance sheet balances because the total assets are equal to the equity and the liability. So it balances out. So my total assets are made up of current intangible assets. So you've got Keisha has an intangible asset line on her balance sheet that has $25 million on it, because that's what she's been offered for her patent. Okay. Most investors aren't going to give her that valuation, but it's a good place to start. Liabilities, what do you owe? Current and long-term. Current is usually trade payables, accounts payable, stuff like that, credit cards, things that are going to come due within different terms. I use current liabilities to be less than 180 days. Some people use less than that. Banks like you to use 90 days for current liabilities. They call long-term anything else. Long-term liabilities are the debt that you enter into to pay over time, long time, years. The equity section of the balance sheet includes paid-in capital, the amount of money that people paid into your company to get ownership, net income, which is what you earned off the income statement or lost, and then retained earnings is sort of a differential between everything else to make the balance sheet work. Okay. All right, this is it pictorially. In detail, it's not a complicated thing. You can make it complicated, and accountants will, but it's basically what you own, what you owe, and what the net worth of the company is. So what I own minus what I owe is the difference is the net worth of the company. So I ask you this, what is an upside down balance sheet? Bill, when you owe more than you own. It's like your house being underwater. Okay, the house isn't worth as much as the money I had to borrow on it. It's underwater. So an upside down balance sheet is something that will get you thrown out of a bank. You're not going to attract investors. So what we want to see over time is even if you start with negative equity in the first year on your pro forma, that's kind of normal because you're going to probably lose money in that first year. We're going to put the money in to make the difference. But the subsequent years, I need to see the net value of that company going up. in a big way, at least commensurate with the cash growth. So cash flow, very complicated, but very simple. How do you get cash and what do you do with it? That's the easiest way to look at it, but we divide it up into 3 sections. The first is net cash flow from operations. For operating the company, are we positive or negative in the cash that is generated by that? In this case, you can see we're going to lose money in the first year, so we're losing cash in the company in the first year. Second year, what is the cash flow from investing? We're going to spend money on things like R&D, on development of our software, on other kind of product development. We may purchase some inventory. There are a lot of other investing things we can do. Financing is basically cash from every other source. What do you borrow? What do people pay you for your stock? Where does the rest of the money come in? Here's the most important part, and the reason I put it in green. What a cash flow statement tells you, beyond being a sanity check for all the other statements, it's a backup to all the other statements. The reason that this bottom part is important is it tells you whether or not you're going to have a cash shortfall. If you have a negative ending balance on this one, you got trouble. You need to get more money from somewhere. Okay, the details are pretty simple. I said I use it as a sanity check because it reconciles the things that are on the other statements. How much do we make and how do we make it in the operation? And then investing, what are we going to buy and sell? So in fixed assets, we can buy property, plant, and equipment. This is sometimes called FF&E, furnishings, fixtures, and equipment. Investment, research and development, or IRAD. This is how we purchase intangible assets. And then the last thing is securities, regular old stocks and bonds. Financing. What are we going to borrow? What are we going to repay? And what are we going to get from investors? The balances at the bottom predict where and when we may be short of cash. The other thing that we'll use it for, and I got to go back to show you, I've asked for $800,000 to be paid in capital. As an investor, I look down at this bottom line and I say, okay, I put the $800,000 in at the end of the first year. How much of it is left? In this case, it's $230,000. I kind of like that. What if that number said 1.2 million? I'd say you've asked me for too much money. See how we trade that off? Okay. Questions, because this is, of everything I've said, this is the culmination slide right here, okay? And when you get this in your PDF form, it's not going to have all this animation. So look at the screen, and I'm going to talk you through it. We got a question?
So is the net worth going to be total equity or total liabilities and equity?
Total equity. Net worth is the difference between assets and liabilities. That's sometimes referred to as the net worth or the book value of the company. Good question. Anything else I've left behind? Everybody in here caught up? Okay. If there was a slide that I would say, don't look at any of the other ones, look at this slide to determine whether you understand everything I've said or not. This is it. How do these statements relate to each other, and why are all three important to paint the picture of the company and its value? So here's the whole picture. Income statement at 12 o'clock, 4 o'clock is cash flow, and 8 o'clock is balance sheet. The first thing we need to know is, what do these statements represent? So the income statement, as I said, is a report card on the operation of the company. Who's responsible for the operation of the company? The management team. Buck stops here. For the statement of cash flows, or excuse me, the balance sheet, as I said, shows the worth of the company. Within a full-blown company, who's responsible most for the balance sheet? The what? CFO is an advisor to who?
The CEO
CEO.
in the board.
Board and shareholders, period. And if you have a CFO that believes their first responsibility is to the CEO, they are like a dog chasing a car. Not gonna be around. Okay, so what I'm saying is the balance sheet is mostly owned by the board of directors because they're gonna make strategic decisions and help you with the buying of property and things like that in the long term that make the balance sheet produce the most value for the shareholders. So what did I say about the cash flow statement? It's a sanity check. And it comes from the other two, but it's depicted in cash. Who owns or who's most responsible for the cash flow statement? Everybody. Everybody in an early stage business needs to be totally focused on cash. If for no other reason, then they are not going to get their paycheck if the cash runs short. So everybody has a stake in the cash flow statement. All right, here's important. Watch these arrows because it tells you what things in what statement are flow to the other statement. So from the income statement, net income, if you remember, goes straight to the cash flow statement. Okay. Cash flow statement, at the end of the cash flow statement, it says cash at the end of the period. That goes to the balance sheet. It also shows what assets we're buying, and that goes to the balance sheet. So what comes from the balance sheet to the income statement is what I told you not to worry about, depreciation and amortization. That's the only thing the balance sheet impacts the income statement with. But you can see through that circle, the income statement affects every other thing that we do. That's why, you know, a typical banker, financier, investor is going to focus on how you project your income statement. And they're going to look that you understand enough to know how it relates to the others. But if you get the income statement right, the others kind of flow. This is all going towards the value of your company, believe it or not. And the reason I want you all, not just in this cohort, but every small business owner, needs to understand how to set the value of their company. If you allow a group of investors like me to come in and establish the valuation of your company, you think that's going to be a good deal for you? No. My job is to try to talk you into a lower value of your company so I get more of it. And that's true of the stock market too. The difference in the stock market is you got all these regulators that keep that from happening, supposedly, and they keep people honest. Well, what I think is that if you understand your valuation in the terms that you've laid out, you have a much, much better way. This is kind of a duh statement. This is, you know, common sense. But I'll take it one step further. You want to avoid getting in arguments with investors and bankers. The best way to do that is to have a very clear idea of the value of your company based on your reality, so they can only have to believe in your reality, not the numbers. Don't. And I call this getting in a slap fight over the numbers. You get in a slap fight with investors, even if you're both bunnies in the tundra or something, the reality is nobody wins that slap fight. Nobody. It all ends up bad for everybody. So we're looking to try to avoid that. But you didn't know I was going to be able to circle that one around to slap fighting bunnies, did you? Okay. Speaking of valuation, we're going to go through the basics now. And this is the part of the presentation where I'll say, it's completely understandable that you will not understand this. So please stop me at every step. The reason it's hard to understand is that the method of valuing your company is user dependent. Investors are going to use one way to value your company. It may not be yours. You're going to use another way to value your company. The key to it is you use all the methods available to you, plus market realities, to get a feel for your valuation over time from everybody's point of view. I'm going to give you the venture capital investor's point of view in valuing things. It doesn't have to be yours. It's how I'm going to look at your company. We pick typical target years. So I just said this to Keisha, looking at her pro forma. She's got phenomenal years 4 and 5. She's got mediocre years 1, 2, and 3, and makes a huge leap in year 4 for valid reasons. There's valid reasons for her doing it. But I pick a target year to say, how am I going to value your company? I'm going to look at, in her case, I'm going to look at year 4. It's the first time she shows growth. It's the first time that I can validate that growth based on product price acceptance. And I know she's going to make it there if she makes the first 2 years. All right, here's the first hard thing to understand. Net present value is a calculus equation used to figure out what a string of money is going to be worth today. So let me use the lottery as an example. Now, you all in this room are young people. If you win the lottery, young people take the payments because they're going to live a long time. What do you reckon somebody my age takes? We take the lump sum because we may not be around tomorrow. Okay. The way you figure that lump sum is that if I were to pay out this $20 billion over 40 years, what at this amount, what would it be worth today? And then I'm going to discount it. In this world, I would say, what is your cash flow over 5 years worth today using this equation, discounted by 20%? It's called the net present value of your company. That also can be used to determine the post-money valuation of your company, or how are we going to determine how much of your company I get for $1 million?
Question,
Go ahead.
why 20%?
When you apply discount rates to numbers like this, it's a measurement of risk. And the reason that we use 20% is that the way the math works out, if you use 30%, it's such a deep discount that it's almost not worth doing. There's a knee in the curve kind of thing. 20% is considered the number you use for the highest risk, earliest stage company. 10% is probably what we're going to use on Keisha because she's been in business for 10 years. She's got predictability. She's got tax records, all that kind of stuff. So she's got lower risk. So we discount her projected net value at a lower risk. You got to ask him if, I hope I answered that for you.
What is a good NPV value?
There is no such thing. It depends on your cash flow. And it's totally generated by numbers. That's why I like it. So the thing to do is to get your cash flow right and attractive and accurate and legitimate, and it's going to generate a net present value that's fair.
Wow, you've gone as low as 10%?
Yeah.
Interesting.
Yeah. So internal rate of return is another calculus formula. You don't need to know. It's automatic in Excel. You can figure it out. But it drives valuation based on what the investor is going to get back. So we started out with what's the value of your cash flow? Okay, that's one method. Now, if I put in 10% in your company, I own 10% of your cash flows, right? So if I put in 10% and it was $1 million, ostensibly your company was worth $10 million. Okay. But what is my rate of return internally based on those cash flows if I get 10% of them? Okay. And it's an internal rate of return. Rule of thumb, venture capitalists and early stage investors require an internal rate of return of 20 to 24%, or we do not invest. It's a given, it's a hard number. So if I can't work out the numbers to show that kind of internal rate of return, I don't care what the net present value was. So I need both of those. Net present value tells me what the value of the company is. If I put in $1 million and it was 10, then I get 10%. Then I double check it with internal rate of return. If I get 10% of the cash flows, does that work out to a 20 to 24% IRR? Okay,
Yes,
go ahead.
so, if you're doing evaluation, and say in her case where she has the glove and she already got sales or something,
Mhm.
and then you wanted to put, like a royalty, where would that come into play?
Royalty is just revenue.
So it wouldn't go into the, okay.
And I would tell you that I think the real nature of your question is if I do a royalty deal on my patent, I license my patent to somebody else, I would tell you need to form another company and you need to do that as a separate deal because it doesn't mix with regular business. So if you want to license your patent to somebody else that's doing a similar kind of software development, or you want to partner with them, form a holding company
Okay.
for your IP. And I would recommend you get your IP out of ownership in your company too. It needs to be held separately.
It's actually having
Hey, there you go.
and all
Okay.
the licenses associated.
All right, the next thing I said was multiple driven averages on valuation. This is where you arrive at the enterprise value. And if you are a stock watcher, got my financial analyst here, what is PE? Price per earnings. Those are multiples. So price per earnings right now on the public markets run anywhere from 0.6 to 1.5. And it's way inflated in the public market. So you figure out what the multiple on revenue, sales, earnings, book value, net value, all these other things are in a market, and you figure out an average, and that gives you a valuation. So we got three kinds. Got to go to this. We have three ways to come to valuation. I recommend you use all three. Internal rate of, net present value tells you the total value of a company based on cash flow. Internal rate of return tells you how much the company would pay to an investor based on that valuation. And the third is enterprise value. And all three of those go into the art of determining what an investment is worth to me. There's one thing that we do not list, and that is what is your exit strategy and what might that be worth to investors? I don't recommend that you entice early stage money with exit strategies. And the reason is if an investor comes in and puts $100,000 into your company and you've told them our exit strategy is to sell the company in 5 years, what do you reckon you're going to have to do whether you want to or not? So exit strategies are a little bit long term. Know your numbers. More important than knowing your numbers, how you got to them, and stick with it. You're going to find bean counters like me, little old guys that just do nothing but look at paper, who don't understand really the value of your business, who are going to beat you down about numbers. If you know how you got to them, you're ready to defend them. If they refuse to understand them, walk away. You're never going to change somebody like that. Believe in your model because that develops the terms of your deal. Okay, quick deal on valuation based on returns. Let me tell you a little story about Same Grain. Started out as way back when, a social media app. It's still out there. You can look it up. They're an app. They did a whole bunch of government business and found out that their particular kind of social media was very good for suicide prevention and veteran outreach, and believe it or not, cruise ships and a lot of stuff like that. So this was our very first internal returns analysis that I just described to you for us to try to determine the value of the company. So remember, the first thing was net present value based on an investment. We needed $1.5 million. Then we figured out the net present value of the cash flows that we projected, and that was $25.65 million. If I put in 1.5 million, I should get a minimum of 5.8% of the company. Okay, so that's net present value valuation. Based on that, if I am somewhere between 5 and 7.5%, what is my internal rate of return for the cash flows that stem from that projected cash flow? So 7.5% of the company is more than 20 to 24%, but we kind of knew that's where they were going to hit. What do you think we settled at? 10. So we settled at 10 and felt kind of bad about it, but we had a clawback or earnout deal that at the end of the third year, if we had exceeded our income, our cash flow projections by 8% or more, then they gave us back 2.5% of the company. So you can, and those numbers, by the way, you can do the formula and work it out. They still made a lot of money. Okay. And by the way, we exceeded the numbers and we got the ownership back.
I mean, I'm not sure this is an elementary style question, but I'm always hearing like Series A, Series B round of funding, and I don't quite understand in context and full what that means. Is there a quick way?
Yeah, there is a quick way, but I'm gonna fast forward you to next week and the week after, where we're gonna talk about it in detail. But just so we can set the basis for that, the levels or sources of money by amounts and types and all that start at bootstrapping. That's what you want to put in the company. Friends and family, which is usually a very small amount. And by the way, does not require accredited investors. If they're friends and family, they're investing in you anyway. Okay. And then the first real formal is angel funding, usually 50 to 100,000, somewhere in there. Seed funding, which is believed to be the enabling funding round in most small companies. And that's 500,000 or thereabouts up to $1 million. A round is over $1 million, and that gets you established and growing in a market. It buys you market. And then B round puts you ready to exit. That answer? And mostly what we're going to talk about in here is bootstrap, friends and family, seed, and early A. That's what we're focused on, because the rest is just a pipe dream at this point, except for you. And Mercy too. So go ahead.
Someone has a question.
Yeah.
I can learn to understand.
Dr. Jen asked, 10 million was that the valuation in the example? Or were you talking about 10%?
No, it's 15. No, we settled for 10% of the company. And that made the post-money valuation $15 million. So we took a $10 million hit, essentially. But we got the deal. So this bottom right is that enterprise value based on multiples of our company as it projected out. So you can see the different values of the company. If we sold it in the 5th year, this is what it should be worth. We do a weighted average and it came out to 62 million and change. We sold the company in the 4th year. Anybody care to guess a number? Yep,
for over?
50 million,
Yeah, I was gonna
What
say
it was
something.
it?
45 million.
45.
45.
Wow.
So it's 4 times what you projected, right?
Not projected in our enterprise value, it's about right.
Yeah.
It's about right. About 20% less than the enterprise value. Plus, they had had all these returns all these times. We were paying distributions and all this. Their return on investment was 104%. Very good for them, very good for us. They put us on the map. The company's ready to go public right now. It's a good deal. It was a good deal for everybody, but it was a good deal because we based it on numbers. And everybody understood the numbers, even if they didn't agree with them, they knew where they came from.
So
And
they
even though
sold-
we didn't agree with their valuation, we worked out something to make up for it.
So they sold, they didn't go public.
We sold the company to a holding company and we retained
Oh.
40% of ownership.
Okay.
So we didn't sell all of our piece.
Okay.
And now the company, because we wanted to keep the same executive team and everything we're doing. Okay. Go close.
Jim, you differentiate between angel and seed.
Yes, I
I'm
do.
just wondering why.
Because they're different types of investors. Seed investors believe that they're going to get a seat at the table in the next round because they're building value. Angel investors expect to lose their money. Small investors. I mean, I can argue it either way. It doesn't really matter.
I just wondered,
You and
wondered.
I are generally,
No, I-
we are seed
that's
and
what I was
angel
asking.
investors
Yeah.
all the time.
General question, more towards the end of this process. I know that we are, preparing to have our stuff ready to pitch and present ourselves in front of investors. But being a part of this program, is there some, at the end of it, would you recommend, for instance, angel investors or other alternate ways to fund, your
By the
business?
time you get out of this, you're going to have sources of capital laid out. So you're going to know what you're going to target. Going after capital is no different than going after customers. You got to look at the market, you got to target the market, you got to know you're going to have a fit. At least intellectually. Okay. That valuation basis gives you a basis for deal terms. But I'm going to say these just this one time. If we're going after seed money, and in same grains deal, it was 1.5 million. This is just how we paid it out. They gave us $1.1 million before we even opened the doors. And then over the next year, they gave us 400 grand. So the total capital investment was 1.5. They got 10% of the company. That made the post-money valuation $15 million.
So they did it in your investment in tranches?
Yes,
Okay.
but it was all under one closing sheet.
Okay, so, but it just said you had to perform these things.
Yeah, they had to put the 400. No, it was triggered on time only.
Oh, time only?
Yeah,
It's not by.
Because they wanted to keep earning money on part of their money, so they put it in escrow until the first year was, I think, 3 months in or something.
Okay.
And we had to show them a big cash flow statement, said, here's how we're going to spend it. All right. That's what that comes up to. Remember that term, post-money valuation. Here's what a package with your pro forma statement ought to look like. Financial summary page, which has those small non-detailed versions of the income statement, the balance sheet. That's the first one. A detailed income statement, a detailed balance sheet, and a detailed statement of cash flows that follow it. Then the next one, yay, where'd we get the revenue and the costs? So the schedule that says where our revenue and cost comes from, capital requirements, and then that internal returns analysis. The last thing will be a proposed term sheet, which is our ask.
You talked about assumptions,
This-
so,
I'm sorry, Crystal.
oh, it's okay, Greg. You talked about assumptions, so is that detailed outlined in any of this pro forma package too, or no?
You're brilliant. Crystal added the one thing that I was going to hope that somebody would come up with, And the thing that's not listed here, but is very important, I don't put it as a part of the pro forma package that you guys are going to develop right now, because it's a little bit superfluous at this point. We'll help, you'll come up with a, you would add another one that is the assumptions, notes, and risks. And that's a standard thing in a package that goes out to investors. It's also part of a business plan, and I don't like to get the business plan. It's like people writing books, you know. So, anything else? How we doing online? Good virtual?
Mhm.
Okay. Right on time. I'm gonna come up with a few notes, and Akosha, please chime in, and Bill and Tiffany, everybody else, as a matter of fact. But here's what's up next. So next week, we're going to get into the details of capital requirements and how to set them. The following week, we're going to go into some pretty deep detail on transactions and terms. By then, I hope to know everybody in the cohort enough that I can use specific examples of where you are and what your terms ought to look like. And then in the 9th week, we're going to talk about the investor package. What do you give out to people? So I have a kind of a Socratic method question here. And I'm going to ask everybody in the room, your impression of how big should an investor package be? You're going to hand it to somebody like me.
I think it should be fairly minimal and very concise because, you know.
Well, how many pages?
Maybe 5 to 10.
5 to 10. Okay, I have 5 to 10. You've been through this, Keisha. How big?
Well, I mean, all of the financial statements are depending on each of those sheets, and that's about 8 pages. And then if you have a business plan, which you want to do a business executive summary first, and then when they request a business plan, because they have all your information at that point, then that's about 10 to 25 pages.
So here's my answer. The investor package has 3 parts: executive summary, financial statements, and the investor presentation, your deck. And you can put them in any order you want, but they ought to be able to stand alone and be put in any order that makes sense. And here's why that investor package is constructed that way. I'm going to send it out to an investor and say, I'd love to get a phone call with you prior to a face-to-face meeting. In that phone call, we're going to go through the deck, not the other stuff, build all your questions, do all that, but I'm going to go through that deck. We'll get to questions. And after that, I'd like to have a face-to-face with you where we'll drill down. Does that make sense? Answer the question. Okay.
Want to share?
Yeah.
That's it on
Okay. You've got some deliverables that are out there. Work with your consultant. Who all needs help? We've got office hours. You can attend in person and hang around here. Okay, yeah. All right. Let's set up some times. And Akosha, let you and I figure out by next week. Let's figure out how we can do, I'm calling it a deliverables workshop, where we can all get together and sit around a table or even Zoom it or whatever.
Is it possible to, like next week's session, to get it like the deck a little bit earlier than Monday? And reason why is because I don't put myself out to travel out of town for my work.
I'm not the administrative ruler. I just.
I don't want to miss anything. I know this is a key item.
Yeah, when do you normally get the slides back?
Whenever she tells me.
whenever they send them to me. Personally, if you guys can give them to me like all today for the rest of the program, that'd be awesome, but as early as you
Give
can.
you what?
Any presentations?
Yeah, that's not gonna happen. So,
They have a lot.
so the question we're dealing with is, can you get the PDF deck earlier than after whenever you upload it?
Right.
Let's make a deal. let's say by Friday before, the Friday before, the PDF will be uploaded.
All right.
Now, let me throw this out there to you. If we see attendance go down, we're going to rescind that. Okay, the value of this course is not me shooting my mouth off. The value is that you all are interacting together and learning from each other. If that attendance goes way down and everybody's just reading the slide deck, not good.
I don't think we can circle.
I don't think we will either. I'm just telling you, the old geezer is putting a rule down. That's all.
Really helps.
Yeah, I don't really think we.
Okay, so we will get the PDFs uploaded no later than close of business on the Friday before the Monday that we're gonna do it.
On Slack.
Yeah, on Slack.
On Slack, sorry. Okay, I have a slide that I want to show you all to get ready for next week that kind of leads into next week, but I don't want you to freak out about it. This is a company that we financed, my firm financed. It was two companies actually, but we put $20 million on the table for these companies. And I want you to see what really won me over about them. What in the world? How do I make that go up? I'm working it. Got it. Here's an example of what they gave me in one of their two companies for capital requirements. The types of things that go into capital requirements are all listed on here. So when you get this PDF, it's a good lead into next week. So you get an idea of what we're talking about. What do you need capital to do in a company? They gave me this and I said, over 2 years, we're going to put in $9 million. And I said, what is the risk of that not working? And they said, oh man, we think we can do it. And I said, would 10 million be the right number? And they said, we guarantee we can do it for 10. And I said, write that down. And I said, we will give it to you on this schedule, but it'll be 5 million and 5 million instead of 4,550, 4,550. And we'll readdress after the first year and see what we're doing. But this listed every single thing they were going to use this for, but not in such detail that they didn't have some, some leeway to run their business and to move things around. So this is what we're going to try to get to next week. And we're going to do it this way. We'll talk about how investors think about it. I just kind of gave you a clue there. Requirements by phase, then capital requirements and milestones, and then strategic capital expenditures and exit strategies. How do they weigh? And then identifying your sources of capital. This gets down to the contact plan, whether you're going to go after debt and equity or both. And then hopefully we're going to show you how to define your own capital strategy that'll last you forever.